waiting. You have been connected for the Hindustan Unilever conference call. Please stay connected. The call will begin shortly. Thank you.
Good day and welcome to Hindustan Unilever Ltd conference call for March quarter 2020. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Suman Hegde, Group Controller and Head of Investor Relations. Thank you, and over to you.
Thanks, Stanford. Good evening, everyone, and welcome to the conference call of Hindustan Unilever Limited. We will be covering this evening the results for the quarter and financial year ended 31st March 2020. On the call with me from the HUL end, I have Mr. Sanjeev Mehta, Chairman and Managing Director, and Srinivas Phatak, Chief Financial Officer at HUL. We hope that you're staying safe and keeping healthy in these uncertain times. Given the exceptional circumstances created by the COVID-19 outbreak, we are presenting the results to you from our respective homes in line with the lockdown protocols. So please bear with us if the things are not as smooth as they normally are. As is customary, we will start the presentation with Sanjeev sharing his perspective on the markets. I will just draw attention to the safe harbor statement for good governance sake and then hand over to Sanjeev. Sanjeev, over to you.
Thank you, Suman. Good evening, everyone, and thank you for joining us on the call today. I hope that you and your loved ones are all well and safe. It needs no gainsaying that the crisis is unprecedented and of a huge magnitude. We are deeply saddened by the terrible impact that the pandemic is wreaking on lives and livelihoods. I speak on behalf of everyone at HUL in extending our deep sympathies to all those who have lost their loved ones and or are struggling to cope with the crisis. Equally, we express our gratitude to all those people who are working heroically at the front line in managing this pandemic. In these times of extreme ambiguity, we are falling back on our fundamentals. Our values are providing us the much-needed clarity and direction. We are discovering the true responsiveness of HUL and the value of our closeness to consumers. There are many unknowns today: the trajectory of virus, the success of containment efforts, the scale and duration of containment measures, the development of effective treatments and vaccines, the significant integration of the resultant economic crisis, the impact on demand, whether it has been deferred, shifted, or lost, and whether there is a structural damage to the economy. In our opinion, we cannot at this stage reliably assess the extent of impact on the economy and the FMCG market or on our business. But we certainly do know that we have a strong portfolio of trusted brands, a very sound balance sheet, and extremely capable teams. We are built to survive in times like these. We have seen several challenges over the decades, and HUL has always been able to navigate through the crisis and come out stronger. Even though the current situation is very volatile, we are confident about our ability to manage the crisis and come out of it in a strengthened competitive position. Now, let me take you through the market context and our imperatives for navigating through the crisis a bit more in detail. Now, we need to look at the market performance in this quarter in two parts: before the acceleration of COVID-19 situation in India and post the containment measures we saw in the second half of March. Even before COVID-19 outbreak in India, the macroeconomic environment had become challenging and the GDP growth rates were slowing, liquidity crunch was there, the demand was sluggish, and there was a weakening of consumer sentiment. In DQ 2019, GDP growth, as all of you are aware, was less than 5%. The Government and Reserve Bank of India, of course, initiated various measures, including reduction in corporate tax rate, lowering of interest rates by cumulative 135 bps over the last 1 year before COVID-19, increased allocations to key sectors like infrastructure, agriculture, etc. While we believe these measures were in the right direction, sustained green shoots and recovery of demand, especially in rural, were not yet visible. Resultant low consumer confidence was reflected in continued deceleration of FMCG market growth before COVID-19. Rural as well as urban growths were lower in comparison to DQ 2019. If you look at on a last 3 months February 20 basis, the FMCG market in our relevant categories grew by 2.5% with volume growth at 1.6%. For the same period, the market growth, value and volume of beauty and personal care, which more discretionary categories, had turned negative. In this challenging context, our brand fundamentals on an overall basis remain strong. We were gaining corporate value share and increasing penetration and market share in a large majority of our business. The outbreak of COVID-19 in India came on the backdrop of this weakening economy. The overall FMCG market growth in our relevant categories entered negative territory in the month of March. March 20 market value growth stood at minus 0.6% and volume growth at nearly minus 1%. On L3 and March 20 basis, market value growth was 1.6% with 1% volume growth. Crude has seen the biggest drop since 91, with WTI crude plunging below zero for the first time in history. With the unprecedented swings in global markets and currencies under pressure, the volatility has increased multifold, ensuring that we do our best to keep the supply lines of essentials open, protect our business model, and maintain our competitiveness continues to be paramount for us. Now moving to the adverse impact in March in the second half. The market slowdown was exacerbated with the outbreak and the ensuing nationwide lockdown. You are aware that even before the national lockdown started, various states and local administrations had sprung into action with containment measures such as sealing borders, closing public places, suspending transport services, and state-specific lockdowns. Hence, the adverse impact of COVID-19 on operation was felt even before 25th, with breakage in supply lines, shortage of manpower, and disruptions in procurement and transport. Immediately following the nationwide lockdown, operations fell and came down to below 5%. In summary, the second half of March was severely impacted with operations running at significantly scaled-down levels. It would be fair to conclude that a large part of the negative growth in the month of March would be attributed to distributor and trade inventories coming down. In April, our supply lines have gradually improved, and now we have reached about 75 to 80% of our normal levels. We have been working very closely with the government at different levels to reboot the supply line. Yeah, the next slide, please. Now, in these circumstances, our focus is around 5 key imperatives, drawing strength from our values. There are people, supply, demand, community, and cost and cash. At HUL, our utmost priority has been health, safety, and well-being of our people, not only our frontline heroes in our factories and the sales force, but also our partners and their employees. We implemented work from home for all office-based employees with effect from March 17. We have implemented strict standards of access control, social distancing in supply chain and sales force, use of PPE, as well as strict hygiene and sanitization procedures. For our customer development and supply chain team, new work protocols were laid down and tiered classification was established at code level. We are also protecting our frontline back-end teams of distributors and depot staff with reimbursement of insurance cover. We've also initiated COVID-19 helpline number, daily health tracking via an app, regular sentiment analysis, upskilling initiative of HUL Learns Together, and continuous communication with our own people and our extended ecosystem. The second area of focus is ensuring that we keep the supply lines open and meet the demand from our consumers for products which are extremely necessary under the current circumstances, such as hand wash, sanitizers, floor cleaners, and hygiene products. As an example, we have ramped up production of hand sanitizers by a factor of 60x from the pre-COVID level. Anticipating that the crisis will continue for some time, we have taken several steps to make our manufacturing and distribution systems much more resilient. As far as demand is concerned, even during this time, we are staying close to our consumers with frequent digital interactions and through a social listening channel, gauging the change in the consumer behavior patterns. Many of our category and brands are more quickly to replan the innovation, adjust to consumers buying in different channels, and rework brand communication to make sure that it remains consumer and contextually relevant. At HUL, we believe we have a frugal mindset. For the last several years, we've had a very aggressive savings agenda. We have now put extra focus on every line of P&L to identify more areas of saving to bolster our financial strength. Last but not the least, this crisis has highlighted the importance of a commitment to use our scale and brand as a force for good in society throughout the pandemic and beyond. I'll now talk a bit more in detail about the initiatives of helping the community, whereas Srinivas will take you through a plan of action in the rest of the 4 pillars in the later part of our talk. Yeah. Now, in a crisis like this, HUL stands with the nation. As I mentioned earlier, it's a purpose to go beyond the business and ensure that we play a part in helping the community. Hence, HUL stands united with the nation in the fight. After announcing a commitment of rupees 100 crores to help the nation fight the coronavirus recently, a lot of work has been carried out by teams to help combat the situation. Our focus is on 3 main stakeholders, our customers and consumers. To provide value to them in challenging times, we have reduced the price of essential products such as Lifebuoy, liquid hand wash, and Domex Flow cleaners. And we have worked relentless to make the products with the reduced prices available in the market in just few weeks. We're also protecting the interests of our distributors and partners with selective and targeted flexibility in managing trade terms and judicially extending credit. On society, we believe that we have to play a bigger role. We are amplifying our efforts right from donating Lifebuoy soaps to the needy to strengthen healthcare infrastructure to spreading awareness to our purpose-driven brands Lifebuoy and Domex. Now, for us, collaborations and partnerships are extremely important because we believe that none of us can help in the crisis alone. So we have come together as a nation and we believe in supporting each other. Hence, we have collaborated with various institutions and government bodies for strengthening infrastructure and creating awareness. UNICEF, the need of the hour is simple and effective communication, and we have a partnership with UNICEF to do just that. Our campaign, Break the Chain, Virus Ki Kadi Todo, has simple yet powerful 5 to 15 second assets based on 3 key themes: social distancing, hand washing, and generosity. This, we believe, will help create awareness and empower public at scale. We partnered with Apollo Hospitals, SBI, OYO rooms to help create isolation rooms in different parts of the country. We have partnered with BMC to create a public awareness campaign, Corona Se Mat Zarona, wherein tips on hand washing to prevent the spread of virus has been shared. Since hand washing is so important and healthy, hygiene habits is part of Lifebuoy's purpose. We are urging consumers to use any soap that is available to them and not just Lifebuoy. We've also entered into partnerships with various local administrations, from Uttarakhand, UP, Karnataka, to upgrade medical facilities for COVID patients as well as provide them with protective gears and our products. In Haridwar, working with the local administration, we have built a 30-bed isolation facility in a record time of just 3 days. Now, coming to M&A, our recent transactions have given a strong foothold in the hygiene and nutrition segment, which are so critical in the current environment. We completed the merger of GSK Consumer Health on 1st April. We are delighted to have the iconic brands of Horlicks and Boost under our fold. This will transform our foods and refreshment business, giving us a strong footing in the wider nutrition and HFD category. We view this as an opportunity and privilege to work towards broadening our social impact and helping our country address the challenges of malnutrition and micronutrient deficiency. On the other hand, we also announced the proposed acquisition of eWash. This gives us an entry into the under-penetrated but rapidly growing female intimate hygiene segment. We look forward to completing this acquisition and strongly believe HUL is well positioned to scale up this business, given the strength of our market development and distribution capabilities. Now, let me focus on the full year performance. Against a tough market backdrop of a slowing economy in the first 11 months and COVID-19 outbreak in March, we have delivered competitive and profitable growth. Our full year growth was 2% domestic consumer growth with 2% UVG. We registered a healthy 100 basis EBITDA margin expansion on a comparable basis. Our PAT grew by 12%. Cash from operations before tax was 9,770 crores. This resilient performance is a reflection of the strength of our brand, execution progress, and the rigor and discipline we have in implementing a consistent strategy. We have grown competitively overall in the segments in which we operate and in full year 2019-20 as well as in the current March quarter. Looking forward, while the near-term market outlook is extremely uncertain, we are confident of the medium to long-term growth prospects of the FMCG sector. We remain focused on delivering consistent, competitive, profitable, and responsible growth through our fundamentals of growth and sustainable business models. With this, let me hand over to Srini to cover the details of our quarter performance and a differential plan of action to navigate through COVID-19. Over to you, Srini.
Thank you, Sanjeev. Good evening, everyone, and thank you for joining us on the call today. Sanjeev has spoken to you about the unprecedented headwinds that we have been seeing in this quarter. The market has been very challenging even prior to the outbreak, and the ensuing national lockdown really exacerbated the slowdown situation. I think it's important to first start by putting a lens on the growth, because I think the headline numbers, as Sanjeev explained, has got a different story to what was happening pre-COVID and post-COVID. I think the first message really is that our performance has been competitive. We are also giving a flavor to it this time. At an aggregate level, in the last 3 months, we have grown our corporate share over 50 basis points, and close to 80% of our business is actually winning share. Our COVID-led disruptions, as Sanjeev explained, resulted in our USG declining by about 9%, with volumes being lower by about 7%. I think it's important to understand that the impact started to happen from mid-March and not to be seen as an impact which came through only after 25th of March. Of course, following the lockdown, our operations then went to near zero before coming back to the 70 to 75% levels that we have spoken about. I think it's also important to give a bit of a flavor on the growth. As we said, we were on track with our plans for the first couple of months and growing competitively. As Sanjeev also mentioned, if you look at the market growth for the quarter being in the range of about 2%, our plans of delivery, if we had actually been able to deliver in full, would have taken us to about sales to closer to 3%. So against what we believe is a normative 3% USG, we actually had a decline of about 9%. I think we believe that about 50% of this loss can be attributed to reduced stock levels at our distribution locations as our primary distribution network got impacted. The balance would have come from lower stock at retailers and loss of actual consumer demand. There was near cessation of sales in some of our out-of-home businesses and ice creams business right from mid-month, and these contributed to the drop. During that period, there was also a bit of an uplift to some of foods and essential categories, which also meant that some of our discretionary categories took a bit of a beating. Hopefully that starts to give you a bit of a flavor on the first box, which is all about growth. Let me give you a bit of a flavor from an EBITDA and some of the bottom line point of view. And I'll walk you through some of these numbers so that you get a good understanding of what's underlying and what could some of be the noise in the system or because of some of the reclassifications and one-offs. We delivered an EBITDA of 2065 crores. On a reported basis, you would see this as a 40 basis points reduction in EBITDA margin. but it's actually on a comparable basis about 160 basis points, adjusting for Ind AS 116. I think that's important to highlight one reclassification we have done during the quarter. There were certain lease-related payments which earlier used to be accounted for, or the credit used to go into the materials line. When we have made a comparison and corrected that, some of it has come into materials. So there's a bit of a reclassification which has happened between other expenses and materials. This does not have any impact on the EBITDA margins. With this correction, if I were to talk to you, the material costs actually increased by 40 basis points. And that's really come through because of the inflation in various commodities such as oils and key materials across food such as SMP, tomato, paste, etc. So that's the first element to understand. Versus the reported number, the material costs actually increased by 40 basis points if I correct for the reclassification. I think it's important to understand that in the quarter and in the month of March, we continue to invest behind our brands. It's important to really build salience. It's important to really focus on the core. And it is also important for us to spend in some of our categories ahead of actually the season, be it skin cleansing or really ice creams. So that is really reflected in our P&L. And when the sales not translating the way we had planned, this has actually led to a significant deleverage. And therefore, when you really look at it, the BMI will give you a deleverage of about 180 basis points. I think that's the second element important to understand as we look at our spends and as we look at our bottom line. There has been improvement in some of our other expenses. As we have mentioned in the prior quarter as well, we have been seeing benefits in some of our supply chain costs coming through from efficiency, saving initiatives, our settlement of some costs, and the work on the footprint optimization that has happened through the year. We've also had some benefits from currency mark-to-markets, which were adverse in the base year. So the combination of this means that we were able to mitigate of the increase in material costs through savings in the other expenses. A combination of all of this would mean that our profit after tax, but before exceptional items, was lower by about 8% at 1,469 crores. You will see an increase in the other income, and that is really coming because of interest we have received from certain old income tax assessments. Our net profit effectively stood lower by about 1%, and there is also benefit of 90 crores that we have received on the tax line from prior period assessments that I've spoken about. So I have given you a flavor of our growth. If I were to give a summary, versus a normative of 3, we had a decline of 9, and I explained to you some of the elements to it. From an EBITDA perspective, while the EBITDA numbers are comparable at 160, there is reclassification between materials and other expenses, and our continued investment in BMI as a consequence of the drop of sales landed up with a negative deleverage effect, or rather landed up with a deleverage effect. If I were to give you a flavor from a division perspective, health, hygiene, and foods have been resilient given the nature of the crisis that we have been going through and the nature of the consumers' buying patterns. As a consequence of this, because it was primarily disruption-led, you would have seen a negative growth across all our categories. Home and home care declined by about 4, beauty and personal care declined by about 14, and foods and refreshments declined by about 7. Within that, I think it's an important element to call out that while categories such as health, hygiene, and foods, which are more essential, have done relatively better, we have seen an impact in out-of-home channels. We had our food services business came to a standstill. Our ice cream business started to really see a sharp decline right from mid-month. And our water business, which was more in durables, really fell to 0 levels. Some of the sales in terms of hair, skin, and cosmetics also got accentuated in the background of a slowing market growth. I think Sanjeev spoke about fundamentals, and even during the quarter, our focus on fundamentals continued to remain. Having said that, with the progress of the COVID situation, we continued to fine-tune some of our initiatives and activities during the quarter. And I think we have a few examples which have really been shown on screen here. I think one important element to call out would be how actually Surf Excel changed its communication from a Daag Achhe Hain campaign to really dhaak ghar pe rahenge, reinforcing the need and the message to stay in home and look at future with optimism. Similarly, given the constraints, we also looked at different models for market development and shifting to more digital medium in the short term. And if I were to also talk about execution, I think it continued to remain our top priority. We have enhanced our sales and operation planning system for a bit and to respond with agility, and that continued during the quarter. And as the quarter progressed and as we're looking into April, we're innovating with new delivery models to ramp up our distribution in this environment. And I'll also cover a little bit about that in the later part of the presentation. So if I were to look at from a segmental perspective, I think there's a difference between the USG and the segment revenue, which most of you will recognize. I think the declines in revenue at a segmental performance would be 4%, 13%, and 7%. I think it's important here when you look at the margins to actually also call out for you one other exceptional item, or let's say an element relating to some one-off expenses. I wouldn't call it exceptional because we're part of the normal results. One-offs that are in the results. While the one-offs from old tax and prior period related matters constituted about 30 basis points at a company level, this had a positive impact of 70 basis in home care and a negative 130 basis in BPC. So therefore, what you see is that the reported margins look a little higher in home care by about 70 basis points, and BPC looks negative to the extent of 130. A combination of all of this really means that at a corporate level, we have 30 basis points adverse in the overall margins. In FNR, we would have seen a drop in the margins, and this came through because of the adverse effect of significant inflation seen in our material costs and under absorption because of our terms of trade given low sales. Some of this was also a calibrated strategy given the quantum of inflation. For example, SMP prices, others had gone up by about 60%. And therefore, I think it was also a calibrated strategy in terms of how we were managing the margins before we got hit by the COVID crisis. So in summary, I think what you see on the results are clear. A negative growth of about 9% and a net profit increase of 1%. For good order, I have called out 3 or 4 elements from a financial perspective. I think those are clear. The first is in fact talking about the reclassification between materials and other expenses. The second aspect being a 30 basis points one-off at an aggregate level, but with really a 70 basis from home care and a 130 basis from BPC, and some benefits from the other income coming from interest and a benefit coming in the tax line from an old assessment. Hopefully, these 4 or 5 elements will give you a better understanding of our financials and will help us taking the underlying business performance in a better light. It's also important to talk about from a full year perspective. I think Sanjeev mentioned it. Our domestic consumer growth for the full year stood at about 2%. If you actually recollect, for the 9 months ended December, we were upwards of 6%. The last quarter having a big impact on our total growth. The EBITDA margins continue to be attractive over 100 basis points and net profit actually being up by about 12%. Overall, if you were to see from a full year point of view, growth has been competitive, profitable, and resilient. This also gives you a very quick snapshot view of the performance at the 3 division levels. The growth is really understood and explained by what we have seen in the March quarter. And at an aggregate from a full year perspective, the margins across all the 3 divisions continue to be healthy. In this context, it's also important to understand that the board has taken a view of the total performance for the year, looked at the cash position, looked at the robustness of our balance sheet, and we're delighted to share that the board of directors have actually approved or proposed an increase of 1 rupee in the final dividend, which at 25 rupees for the full year, this will be about a 14% increase to the dividend payout. And with this, we believe is actually going to be in the interest of our consumers and our shareholders. I have just one second. I'm just having some connectivity issues. Just give me 1 second, please. Yeah. I think it's important to spend a little bit of time talking about the future. You would have seen this chart I think our strategy remains unchanged, and our model is one based of consistent, competitive, and profitable and responsible growth. And as Sanjeev has spoken about, it's really dialing up and focusing on the fundamentals. Sanjeev also talked to you about our 5 key thrust areas. And what I will now try and do is give you a little bit of a flavor of some of the aspects that we are talking here. We have taken utmost importance to the health and the hygiene and safety standards of our people, whether it is by getting some of our office-based people to work from home, or providing the best-in-class facilities in our operations, be it in factories, or actually even in some of our extended areas such as distributor operations and third-party operations. We've also worked with the government in terms of the Suraksha stores and building the awareness so that actually helps our partners, which is really the retailers. And I think one important aspect to call out would really be that we have actually extended special medical insurance coverage to our frontline people, people at our distributor points, depot staff and contract workmen, all in all over 20,000 people, to make sure that we take care of their well-being in this hour of need. The other piece is really on supply. We have spoken about, and Sanjeev has talked about a few examples of actually ramping up of capacities in key categories such as sanitizers, and he talked about the kind of increases that we have done, more than 60%. And we are taking various initiatives to really bring back operations to normalcy. From what started as below 5%, progressively moved up. If you were to look at the last 10 days, we would say our operations are in the range of about 70% back to normalcy. And Sanjeev also talked, if you look at the recent numbers, it's also moving up to 75 and 80. Now, what are we doing? I think we are actually focusing on some of the key SKUs, taking into account the portfolio, taking into account the geography. And actually, we are focusing on a few key SKUs. And in the short term, we are not looking at the full assortment, and we are also making some choices there. This enables us to expand capacity. This also enables us to get the right kind of product mix in front of our consumers. From a supply perspective, I think we are looking to really increase the dispatch capabilities. Today, that's come up in a much better space. We're also working through procurement and supply chain resilience plans to make sure that our operations continue to get packing material and raw material. In some cases, we're also looking at tactical opportunities to tie up capacities to really serve the needs of our consumers. And I think that also becomes an important one. On the distribution side, I think we have continued to look at various models, which included partnering with some other partners of the likes that we have mentioned there, Swiggy and Dunzo. In some cases, working with our customers, and the customers have actually come up and picked up stocks. We have worked on such models. And we are continuing to dial up both Hamara Shop as well as our Shikhar, our B2B ordering app. And this has been useful as time has progressed in terms of taking orders and actually making sure that we are managing deliveries. The next piece is really all about demand and portfolio. We will see a definitive shift to some of the changing patterns to demand. Health, hygiene, and nutrition will become focus areas, and I think there we will continue to bring a lot more innovations to the marketplace. In the short term, we also expect some bit of negative impact from discretionary categories, and we'll continue to watch that. You'll also see that there are some host of consumer-relevant innovations we have put out, and also contextual communications. What we've done is given you a flavor of some of the innovations which are either in the marketplace or are likely to come through very, very quickly. So we've got a range of sanitizer SKUs which have come through. We're also bringing in Lifebuoy Germ Kill Spray and Domex disinfectant sprays into the market. And there will also be other innovations such as the germ removal wipes, cloth sanitizers, and actually germ wash boosters. So some of these innovations are happening as you speak, and there more will come over the next 4 to 6 weeks and to land in the market. Sanjeev has spoken extensively about our community initiatives, and it's important for us to say that, and I will not repeat them, but this continues to be a super important pillar for us, and it's integral to how HUL does business and how we win in the marketplace, and we will continue to keep a focus on all of these initiatives. And the last piece which I will talk is really about cash and cost, and the importance and the need for protecting our financial model. And I think we're looking at both from sources and use of cash, as well as stepping up our fuel for growth. So clearly there is going to be a laser focus on receivables, Having said that, we will look at judiciously deploying credit to support our partners and bring back normalcy in our operations. Through our enhanced S&OP and focusing on key A-class and B-class SKUs and bringing data and analytics, we will continue to bring more science to inventory management, and that will help us manage in this evolving situation. Over the next few months, we will continue to look at all capex and restructuring expenses with a sharp focus. And to some extent, we will be deferring some of the expansion plans unless they are really supporting us in terms of capacity. And we'll also balance it with our ability to execute. Therefore, there will be a clear focus in terms on what we do in terms of our spends here. Equally important is we'll continue to unlock opportunities to get surplus assets and realize cash, which will actually shore it up. And finally, while we do all of this, I think it's important that there's a lot of turmoil happening in the credit markets and debt markets. We will make all efforts to ensure that there is safety of our investments and there is liquidity. Equally, as we continue to do that, I think there is a need to really step up fuel for growth. We almost have moving into a mindset of earn and then you spend. And this really means that we are dialing up savings across the value chain. We'll also be looking at a dynamic reallocation of spends in line with the markets and what gives us the right ROI. So for example, in the quarter, we have looked at a bit of a rebalancing of our media expenses across channels. And this is something we will continue to keep a close eye, both from a competitive context as well as a consumer demand context. All expenses which are non-core or which do not really add to growth, we will actually be very brutal about them. And we will drive decisive reduction in all non-essential costs. Some of the examples of travel and some of the other expenses are very visible. And I think this lockdown has also taught us some new models of how we can actually manage costs and be very efficient and effective. In all of this, it also becomes super critical for us to continue to drive our synergy savings from the nutrition business, and we will implement those plans with rigor. So if I now come to my last chart before handing over to the Q&A section, I think we'll all agree that where we are is actually in unprecedented times. We are dealing with lockdowns, we are dealing with spread of the virus, and we're all working towards a new normal. Therefore, it will only be fair to say it will be difficult to estimate the market growth or the consumer demand at this stage. Volatility input costs and currency is likely to continue, and liquidity pressures will remain elevated. And I think, therefore, if you really look at the approach, I think the best way to summarize it, we will protect our business model, we will grow competitively, and we will contribute to the nation. And we have spoken to you about the 5 pillars through which we will do it. And on this note, I will hand it back to the operator to enable us to take the Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star, then 1. The first question is from the line of Avnish Roy from Edelweiss Securities. Please go ahead.
Yeah, thanks for the opportunity. My first question is on the distribution. HUL has done the tie-ups with CT, Dunzo, etc., and many other innovations they have done. So how is the cost structure different in this distribution? And is there any pushback from Kirana because same consumer might be targeted by the Kirana and by these players? Third is, do you see this as a long-term trend, or once normalcy comes because of the cost structure, things will go back to the earlier framework?
Yeah, thank you, Avnish. Thank you for your continuing to remain the opening batsman. Yeah, what you're talking about is what is going to be the trend in the future and what is going to sustain from the changes that is happening now. When supply lines got disrupted, our main motive was that we should manufacture as much as essential and reach them to the consumers through whatever route was possible. So in the short term, you don't focus on cost versus the normal operating procedure. Your entire focus is on ensuring that the goods reach the consumer. From a long-term perspective, I believe that first, this could also be possibly a renaissance of the grocery store, where people have realized how important your neighborhood grocery is. But this will also give an imperative for the grocery to adopt technology. Things like a Shikhar app or La Hamara Shop, that will become very critical. The second is, yes, it will give a fillip to e-commerce and even the traditional e-commerce, as well as new models of e-commerce will emerge. Yeah. And the third is, even the modern trade, I think, will have a big thrust towards the omni-channel. All these things will play out, and only people who have got sustained business model will be able to survive in the long term. So I would say right now, too difficult to think as to what will survive and in what shape and form. But yes, the 3 big things that I talked about, the omni-channel for modern trade, the renaissance of the grocery store with added technology, and of course, e-commerce, this will give a fillip to all 3 ways of reaching the consumer. Yeah. Next question.
Thank you. The next question is from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi, good evening, everyone. My question is, if you can give your views on how the current situation is going to affect urban versus rural. Last couple of years, we have seen rural growth falling below urban. Now with the lockdowns being much more severe in urban areas, etc., do you see the situation reversing, and on a relative basis now rural becoming more attractive or performing better than urban? That's my first question.
Yeah. Okay. Hi, Panthaki. How are you? Trust you are well. Now,
yes,
coming to rural, there are a couple of variables at play. First is that there has been a direct benefit transfer to a large number of rural consumers, and which will have an impact on demand. There's no question about that. The other big variable at play is that the recent harvest, to what extent have they been able to get the workers to work on the harvest, and to what extent they have been able to transport the stuff to the mandi so that they can get proper realization. And the third variable, of course, is the rains for the subsequent harvest. So these are the 3 variables at play. But I feel confident that the transfer of benefits to rural consumers, and if the virus does not spread to rural areas, and if it remains contained as it looks like today, then yes, it will augur good for the rural consumers.
Right, sir. Sir, second question is on cost savings. You mentioned that in this kind of environment, you will look even more closely at costs. So can you give some more granularity on this? Typically, in the last couple of years, you have been saying that your CEPs are around 7% of sales. To what extent do you think this can increase from 7%? To what extent do you think it can increase this year? And also, which particular line items? You did mention travel, etc., but any further light, if at all, you can throw on this?
Srini, would you want to?
Yeah. So I think, Percy, I think the need is very clear. Yeah. When you look at an economic environment as such, any cost which is not really adding value to the business or to the growth is under question. So obviously, with all of this, with the new models that we have learned, I think there are many more that we can do in terms of some of the normal ones, the usual ones. Some aspects such as travel, I think it's both from the safety and health of our people, as well as with the technology available, becomes the very easy and the obvious ones. For example, we've also looked at our own people costs and our own committed costs, whether it is across the value chain. Clearly, we are now made some decisions in terms of putting any recruitment on hold, any fresh recruitment on hold. We will honor the commitments that we have made for some of our trainees. Absolutely, we need to do that. So that's another kind of a look at what we're looking at costs. We are for temporarily also pausing and reviewing some of the increments which will come to mid-management from middle of the year. That's something which we'll also want to pause and review into the future. This will also throw up opportunities for us if you given our scale and our ability to leverage cash better. We also expect to start seeing better savings coming through in all lines. It could be in procurement. It is likely to be in media to some extent and non-media. So that's again something which will become one of our key and focus areas. And the last piece also is going to be a mindset which I spoke about. I think the whole organization is fully aware and conscious and working into a mindset of saying we earn and then we spend. And you'll really be surprised the resilience and the agility with which the organization moves in an environment like this. So for us, I think the ambition continues to be we need to drive savings. How much and how much more, I think will come through in time. But that's really the kind of approach that we will take to actually driving and taking costs out of the system.
And one more philosophy, if I may add to what Srini has alluded to, is our endeavor would be to create optionality depending on how the things open up. In the long term, all costs are variable. But in the short term, there are some fixed and some variable. And our objective will be that to an extent, some of the fixed costs we can convert it to variable. That will then give us the flex to take the right actions depending on how the economy pans out.
Understood, sir. Very helpful. Just a related question to this. You have consistently mentioned that on a full year basis, you will always look at modest operating margin expansion. Now, these are very, very exceptional times. So just wanted to understand if that sort of mindset or that kind of guidance still remains this year.
You're absolutely right, my friend. These are very exceptional circumstances. Yeah. Now, our first thing would be to ensure that we keep growing competitively. Yeah, that's number one. The second focus would be on ensuring that as much growth as we can get, we bank it. Yeah, that would be the big thing. Because for us, a lot of leverage on costs comes from the top line. So that would be it. And the critical aspect of our business would be that we have to preserve our ecosystem, not just us. We have 3,000 plus distributors. We have millions of stores we cover directly. We have hundreds of suppliers who are part of the ecosystem. And our objective will be that we are able to ensure that they keep running the business so that we keep running our business together with them. So that would be. And last but not least, we have to focus on ensuring that the integrity of our business model remains intact. Yeah, margins at this stage, when you don't have visibility to how the economy will pan out, it will be very difficult to predict what we will do. But we will always look at it from a lens that we are here for the long term and we have to preserve the business for the long term. That's where our objective will be.
Understood, sir. Thanks very much. I have a few more questions, but I'll come back in the queue.
All right. Thank you.
Thank you, Percy.
Thank you. The next question is from the line of Manoj Menon from ICICI Securities. Please go ahead.
Hi, Sanjeev, Srini, and Suman. Thanks for a very detailed, presentation and a very different, presentation as also. I have only two questions addressed to Sanjeev. Sir, one thought process is that, at least in my understanding, the marketing fraternity is that, this force the staying away from using a lot of product categories, particularly in personal care. Does this lead to a reset of excess consumption? So in simple terms, if I'm to say, let's say something like a shampoo category, the consumer probably is consuming a lesser quantity, assuming that's the right assertion to make. Is there a challenge for the marketer to build back the penetration and the per capita consumption? That's question number one.
Yeah. All right, Manoj, thank you for that question. Yeah. Today what has happened is people's perceptions are being swayed by what has happened in the last few weeks. And the last few weeks have been very abnormal because the supply lines have collapsed. People have not had access to go to the stores. And the entire focus has been on getting the essentials like food products, hygiene products into their homes. Yeah. But we have to understand that the relevance of the category and also the focus of germs from hands, clothes and services will move to hair, mouth and face. Yeah, this is bound to happen. The second important bit is you have to realize that the need for things like moisturizing or the things like, for instance, if you wear a mask the whole day or for a long period of time, yeah, clearly you need face care products to ensure there are no marks left. Yeah. So there would be need for certainly beauty and personal care products going into the future. There would be some shift in demand. Some may be temporary because top of mind is your health, hygiene and nutrition. But then, who in the world, a man or woman, doesn't like to feel good or look good?
Fair enough. Fair enough, sir.
Just to add just one small comment to this, I think some of the elements which Sanjeev has spoken about, we've also started to see some of this come back in markets such as China. Yeah? So that's clearly the hypothesis is playing out, and we've started to see that come through in the markets.
Understood. A related question, here actually on this is that, one thesis about, let's say, market shares is that, any such dislocation essentially ensures that the stronger players, comes out stronger, even stronger. But the only question here is that, given that, at least what I've been reading, that consumers are now buying categories and non-brands, just on availability, there's a lot of, sampling which would have happened for our brands which would have otherwise kind of, struggled to. How do you look at the next year in terms of, again, is there a question of, necessity to increase the value quotient, etc., to bring the consumers back to the fold?
Yeah. Thank you for that question, Manoj. You are right. When your supply chain has been disrupted, people would want to get any product in the category that they can lay their hands on. Yeah. But this is not going to remain forever. India needs, we are not a one-horse player. Look at the laundry, look at the hair care, yeah. In all the categories, look at tea. In all the categories, we have brands or formats or pack sizes which provide access to nearly every consumer. And great value. That's our strength. Portfolio is our strength. Yeah.
Understood. Thank you so much, Sanjeev. In fact, that was just a follow-up which I had on, God forbid if, the dreaded word of downtrading is to make a comeback, the readiness of the portfolio was something which I wanted to ask.
Look at it like this. If you look at our tea business, we have Taza.
Sure.
If you look at our hair care business, we have Clinic Plus. If you look at the laundry business, we have these. In all our big categories, you will find this. And then, even when it comes to our big brands, we create value through access packs and low unit price packs. So that is how we play the game. And when times are good, we have brand which captures the premium end. And when times are tough, we have brands which capture the value end.
Sir, one last question, if I may push in here. If we are to do a crystal ball gazing, would you believe that, let's say, the likely scenario is an SKU downtrading versus, let's say, brand downtrading, which is a higher probability?
Consumers, when times are tough, look at value. Yeah, and to them, the value becomes the most important part. Even when times are tough, I believe Surf Excel 10 rupees pack will still keep selling because consumers think that it gives them great value. It might happen, Manoj, that there might be some shift from, say, bottles of shampoo to more of sachets, for instance, or more like a 10 rupee pack of soaps. That would happen depending on what is the economic condition. But we have a portfolio which is completely ready for this kind of scenario.
Understood. Thank you so much, Sanjeev, Srini and Suman, and all the best and stay safe.
Thank you. You too.
Thank you so much.
Thank you. The next question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good evening and thanks for your time. So 2 questions from my end. Firstly, you talked a lot about cost saving and even things like maybe holding back on some of the increments for the mid-level staff. And obviously this is coming from probably one of the most profitable and cash-rich companies. We are seeing across different industries that there's probably going to be a lot more cost saving and savings initiatives of that sort. Don't you think that will have an impact on medium-term demand? And then how are we being so confident that medium-term demand will come back?
That's a very valid question, and that is the reason why we have still given a dividend increase. Yeah, because we believe that we have a strong, healthy balance sheet, and then there are huge number of shareholders, non-institutional shareholders, and in many cases also institutional shareholders, because the money again goes back through the mutual funds, etc., back to consumers, the individuals, citizens of the country. Yeah, and so that is the reason we took that call of not cutting back on the dividend, but increasing the dividend on a year basis. Yeah, the second bit is, in the first quarter, we are ensuring that we don't lay off any people. And when I say the first quarter is the quarter of June, and we have not cut back on salary. Yeah. That is what we have done, because we also have to look at it from a perspective of the nation. But then when we say that it will depend a lot on what is going to be the economic conditions, to what extent the lockdowns will continue, and then we also have to ensure that we preserve the sanctity of our business model. Yeah, that's important. So costs during this time, which will not, let me give you an example. We have a very extensive house-to-house sampling program, which comes under market development. Now, market development, if things remain under lockdown for extended period of time, might become very difficult to execute, right? Then we will think to ourselves that how do we retain the essence of the capability within the organization, but trim the cost which doesn't add value today. So that's the perspective we will bring in. But whenever we look at bringing down costs, we will ensure that we don't erode the organizational capabilities of the business.
Very clear, sir. Thank you. And the second question is basically in terms of, you talked about supply coming back to 75-80% of levels, any update on what the demand situation is, or what you can see from sort of end retail where demand is at this point?
See, you know what, if you remember what Srini was alluding to, that in the month of March, or what our numbers are, that we should normally have delivered a value growth in the vicinity of 3% because we were gaining shares, and the market was at about 2.5%, whereas we ended up with 9%. So this 12% spend, the difference, 50% of that was distributor stock. And the balance, 2/3 would have been trade stocks, and 1/3 would have been demand when everything came down, would have either been deferred, or it would have been, the demand would have gone away. Now, today, our challenge has been to get the supply lines running. Yeah. And when I say supply lines running, it is not just the sourcing of raw material, but it is also manufacturing and then distribution. Today, with the lockdowns, today with the restriction on number of workers to deploy, today with so many of the stores across the country not having opened, we have not been able to gauge to what extent the stocks in the trade have gone up, and when things return to a modicum of normalcy, what would be the pent-up demand of the consumer and of the stores to fill up the inventory. Both these aspects would be there. But it is not yet possible for us to gauge how much of that would be.
Fair enough. I totally understand. And thanks a lot again for your time.
Thank you. May I make one request, please? I think we have a lot of questions and we're conscious of time. If each of you can pick up the critical one question that you have in mind, so that we at least cover everybody's questions.
Thank you. The next question is from the line of Arnab Mitra from Credit Suisse. Please go ahead.
Yeah, hi. Good evening, everyone. My question was, as you look at the 75-80% production moving, or supply levels moving to 100, the current bottlenecks are, is it still to do with some permissions on factories, or is it more to do with you have permissions but the factories can't operate due to social distancing norms or supply issues, or is it transportation? And in this period from, let's say, end March to, let's say, mid-May or end May till your supplies are not there, is your sense that there is a stock out at retail levels, or retail end stocks are still there, and therefore there is no loss on the offtake side during this period of time?
Yeah, so, supply chain works in a synchronized manner. Today, what is happening, for instance, whenever the government finds that a zone becomes red, then anything within a certain radius is shut down. So we have had cases, because we have large number of factories spread across the country. The factories have started running, and then they have seen red cases sprouting in the neighborhood, and then they have brought the factory again down. Then again we have to seek permissions to make them run. Yeah. Similarly, for instance, the ports have been working at a very low level. Yeah, we would have issues about raw materials, etc., coming in. Yeah, so then there is an issue of transport. Then there is an issue of workers and laborers. So all that has to move to a synchronized fashion. But I think I will give full credit to my operations team, the way they have innovated and the way they have stepped up, that despite the constraints, they have taken the production and sales to the 80% level, using many innovative schemes. Yeah, the workers working long, selling full truckloads to distributors so that they directly reach without any interruption, and then innovative means of distribution. So many things have been used to reach. Now, what you were talking about, that will there be a trade stock coming down as well as possibly offtake? Difficult to gauge. My sense is that there would be both. Yeah, because for many of the products, our whole focus has been on first just essential products. And many of the things, yeah, which like the shampoo, for instance, or skincare, for instance, there would be a pent-up demand with the consumers because they would not have got access to the products in the stores because they would have got over. And also the inventories in the stores where they are available would have come down significantly. So there would be both factors in play. Yeah, just a 15 days disruption, gentlemen, impacted 10% of our sales, 6% on distributor inventory, and 4% on the trade inventory. So you can gauge that how when a smooth supply chain working very efficiently gets disrupted, what happens to the pipeline. Yeah. But what we are also doing is making our chain much more resilient so that even if this constraints remain, like slowly we have moved up to 75-80% level. Yeah.
Sure. Thanks. And just one follow-up on this in terms of the Horlicks, so GSK's business, which is now this quarter onwards with you. You have put it in the essentials list of in your slide of essentials. Just wanted to understand, because in the past we have considered this category somewhat as a bit of a discretionary category, not absolutely essential to the day-to-day requirements. So any thoughts on that?
I am glad you have raised this question. Yeah, besides hygiene and sanitation, the other very important bit is nutrition and immunity. Yeah, and a brand like Horlicks does provide you immunity. In fact, today, if you go and see, we have given a news release that Horlicks with added zinc has been provided to scores of hospitals in the country to help boost the immunity of the health worker. Yeah, and this is a proven science.
Okay. Thanks so much, Sanjeev.
Welcome.
Thank you. The next question is from the line of Vivek M. from Jefferies India. Please go ahead.
Hi, good evening, everyone. My first question is again on the utilization rate. So when you're talking about, Sanjeev, 80% utilization rate, and there is a clear demarcation between essentials and discretionary, does that mean that in case of essentials, the utilization rates will be even higher, further higher, whereas in case of discretionary, it will be far lower? Is that understanding correct?
You are right, because even our focus has been on first making products which are essential under the current circumstances. Yeah. Then, Srini alluded to a figure, or I spoke about that.
There could also be some shifts between what parts of your portfolio sell. In some cases, it's quite possible that you will have higher sales of low unit packs coming through, at least during the next couple of months. Obviously, when you want to do all of this and when you add it up, you want to protect your business model. And that's the reason for us to be calibrated about all spends. We absolutely want to invest behind our brands, but I think we need to really think about protecting our business model, because we will come out of this. Yeah? And we will come out of this, and there will be a spurt in demand, and they should have enough ammunition to really invest behind your brands. So that's the reason for our thinking in terms of the way we are articulating.
I see. Thank you very much, and wish you all the best and stay safe. Thanks.
You too.
Thank you. The next question is from the line of Sanjay Mania from ICICI Direct. Please go ahead.
Hello, sir. Just a few questions specifically. As you mentioned that you have seen a higher production of sanitizer, but what about the personal wash category? What about the soaps? Have you seen, or do you really think that the structural change can come in the personal wash category? Per capita spend probably can increase dramatically, and probably the kind of growth probably this segment would remain probably for next 1 or 2 years.
We believe that the heightened need for hygiene and sanitation is not going to disappear overnight. Yeah? It will come down from the peak levels, definitely, but it's not going to disappear. And people will hopefully understand that having the right kind of behavior with sanitation and hygiene is a proposition that keeps you healthy and safe. Yeah, there will be a spike in liquid soaps. There will be a spike in soaps with health credentials. And not just health credentials, any soap is I'm sure people will be much more conscious about washing their hands more number of times and becoming, whether they're also using of disinfectants, cleaning surfaces, making the environment more hygienic. These are some things which are, I think, I believe will be there for some time. They're not going to go away. Hopefully, it will translate into a permanent shift of consumer behavior.
Right. So just in the single...
Sorry to this. May I really request people to stick to one question, because we have about 14 people on the audio and I got 20 questions on the web. If you really don't mind and if you can come back, time permitting, I'd really appreciate that.
Okay, thank you.
Thank you. The next question is from the line of Shreyas Thakkar from Society General. Please go ahead.
Hi. Just wanted to know what the impact of pantry loading is in terms of different categories and on the group level.
Too early to assess.
So anything post in the second half of March? Sorry.
Second half of March. Yeah, it's second half of March. We are very difficult to assess because, at the end of the day, we were not even able to service our distributors. We were not even able to service retailers. So very difficult to assess how much would have been the offtake. There is one impact of, you have to understand that when Nielsen comes out with a figure, they are saying that the FMCG, the categories where we operate in March were down by a negative number. That would indicate that there wasn't much of pantry loading.
So I think anecdotally, and to look at some trends, there was definitely a little bit of pickup in cleansing, sanitizers, a little bit of nutrition. So we saw a little bit of that. But that started to happen, but we also then started to see sharp deceleration in some of the discretionary categories, for example, ice cream. So some parts would have seen it, but as Sanjeev said, it's very difficult at this stage to get a number in its aggregate. But clearly we did see a bit of a move up in sanitizers, we saw it in soaps, and we also saw it in some of our household cleaning products.
You stay safe, guys. Thanks.
Thank you. The next question is from the line of Prasad Deshmukh from Bank of America. Please go ahead.
Hi, good evening to all of you. One question on your warehousing strategy. So till now, the focus was always on, post GST, the focus was on reducing the number of warehouses. Considering it is becoming difficult to reach even distributors, as you're saying, would there be some change, at least temporarily, in terms of opening more warehouses so that the supply is streamlined, or is that?
So I can answer that. So look, I think the important piece in the short term, I think fundamentally into the medium term, I don't think there's any change to the strategy. I think in the short term, I think we have to deal with a few variables, and I think we spoke about containment zones keep happening from time to time. Yeah. It's really linked to what's happening to some of the outbreak. Yeah. So we are looking at multiple models, including, and obviously the closer you have the stocks to the retailer and the consumer, it is better for you. So to that extent, we are looking at multiple models, and in some cases, including looking at space with some of our distributors to make sure that stocks, reach there. So in the interim, we are looking at multiple models, direct dispatches, stock at distributors, some temporary space. And I think in the medium term, or let's say in the next near term, it's about continuity of supplies and getting it to the consumers. But I think then when you come back, I think to the fundamental strategy, I don't think there should be any change. In the next couple of months, we are taking many of these steps to make sure stocks are available.
Will you have any short-term cost implications, or will that be all distributors?
No, there will be short-term cost implications. Okay. I think the important piece is on the short term, there are 3 or 4 things we need to think about. There are some cost implications because of the additional measures that we are putting in for health, hygiene, and safety across the broader ecosystem. In the short term, we've also seen a bit of a step up to costs coming through from distribution costs. Most of you are well aware that there was a limited availability, and also the costs of many routes had gone up, just given the risks involved and people being reluctant to travel. So that also has gone up. some of the steps that we are taking in terms of continuity is also leading to some costs. So in the short term, yes, there are elements of costs which are going up and which we need to manage and navigate, and therefore, again, the need for protecting the business model.
Sure. Thank you.
Thank you. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Good evening. Just one question. On slide 13, you mentioned the impacted categories. There are 6 categories there which you mentioned. Would the assumption be correct that these are all technically non-essentials and you haven't been producing these categories at all in April?
So look, the point is, it's not about, if you really see the split, ice creams and out of home, we have produced a bit, but just given the nature of what's happening out there, you can't sell any out of home. Because a large chunk of ice creams comes through from an out of home perspective. In the initial few quarters, we had not manufactured some of this. But as we speak today, we've started to get some of these products coming back up, and especially in terms of skin and hair. Ice creams, we are manufacturing a little, but sales continue to be low. What's a bit of a durable thing, and I think for that to pick up, you'll really require the broader markets to be opening up.
So technically, you're allowed to do skin, ice cream, hair, even colors.
You need to get approvals with the relevant authorities in the right by going to the right authorities, and you are able to get approvals. Where you're able to get approvals, we are producing. So slowly started to open up from some of our beauty and personal care products.
All right. That's it for me. Thank you. All the best and safety.
Thank you. The next question is from the line of Binoy Jariwala from Sunidhi Securities. Please go ahead.
Hi, good evening. Thank you for the opportunity. Just one question. Is there any clarity that you've received on the tax amortization available from the share swap value of roughly 32,000 crores?
Suman, do you want to answer that, please?
Hi, Binoy. Good evening. So we have looked at the overall tax amortization piece, and I think from your and most of the people on the call's perspective, it's more about what is the implication, if any, of the amortization of the intangibles coming on the ETR for HUL. At this point in time, we do not see any material impact of these benefits coming to the ETR of the company. Why so? So let me just explain a little bit in detail, but I think we'll leave it for the call in May that we plan to have on a more detailed update on the merger. The benefit of amortization on intangibles when they come on the merger is only available in tax books, right? So in accounting books, which is where you look at the ETR, goodwill or intangible items are indefinite in life, are only tested for impairment. And it can only result in a creation of a deferred tax asset or a liability, which is a knockoff between a current tax and a deferred, with no implication on ETR. Yeah. So the nuances of what tax amortization will entail and how will it really materialize in the tax returns for the company is something we'll explain more in detail in May when we do a full GSK merger update for you. Yeah. But for suffice it for now to say, there's no impact on the ETR for HUL.
So just a clarification on this. What you're saying is that from the accounting perspective, there will not be a material impact, but a cash tax outflow, that will be materially lower because we would be receiving this.
No, please have a look at materiality, and that's why I said I don't want to get into full tax implication discussion now, and let's leave it for May. But even from a materiality point of view, you're looking at from a finance income and the yields that this will generate from a tax, it is not very material at an overall HUL level. But let's discuss that, I think, in the May call, because that's more about how the implication on tax. Really, from a cash flow perspective and income perspective, it's not material for a company our size. And from an ETR perspective, I'm saying it has no implications, because it doesn't get amortized in the accounting books.
Yeah, take it. Thank you.
Thank you. The next question is from the line of Amit Sachdev from HSBC. Please go ahead.
Hi, good evening. Thank you for taking my question. So I have one question. Obviously, you alluded to the challenging time and restoring supply chains and getting the whole operation back and up and running is the first priority. But I would also perhaps guess this is a time where, an opportunity to strike with innovation is higher for stronger players such as yourself. Are we taking advantage of this position in some way while this supply chain shortages continue, or are we just effort is only to sort of maintain status quo somehow? Is it giving us any competitive advantage? While I would assume smaller brands would be in proper disarray, and not necessarily I would think that they would probably in a good position to innovate or do A&P or something like that. So how are we taking advantage of this disastrous situation?
Let me take this, please.
Yes.
There are two questions which you have. One is, are you working on innovations? Based on the changing consumer trends and based on what the new needs of the consumers are? The answer is absolutely yes. The second question that you're talking about is those innovations, which you have been able to scale up today with the constraints that we have today? The answer is no. But yes, we are getting it into the market, and once things open up, we would be able to ramp up production and also distribute it to scale. Right now, you have to understand our focus has been on essentials. If we can't even get essentials produced to the level that we need, we can't be looking at anything else. We first have to get soaps and sanitizers in the hands of people. That is the most critical thing.
Just to add to what Sanjeev said, so even if you look at the chart that we presented on demand, there is definitely an elevated interest in health and hygiene. And therefore, if you really look at some of the products that we're talking about, disinfectant sprays, wipes, cloth sanitizers, these are all, again, the innovations which are actually on trend and a requirement of what consumers need. And in this kind of cases, we are actually gone from concept to production in a matter of few weeks. If you really say this is all of less than 4 to 5 weeks old, you'll actually start to see some of these products actually being in market in as early as 5 weeks and 6 weeks from the concept. So yes, relevant, consumer-relevant innovations will absolutely be the focus area, but it's a sequence of getting the supplies and then continuing to innovate.
That's very helpful. That's what I really meant, whether we are taking advantage in some way that, well, perhaps the opportunity also provides us.
Absolutely. Absolutely right.
May I ask a little bit one question which I just missed on the exceptional thing Srini was talking about, because I think line was very bad at my end. If you don't mind giving a little bit clarity, if not, then I'll take it offline as well.
Amit, if you don't mind, you can reach out to our IR team and make sure that we cover all of those elements. Yeah.
Sure, no problem. No problem. Thank you so much.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum. Please go ahead.
Yeah, thanks for the opportunity and good evening to all. Just few observation, and if I go back in Q3, when the difficult times were there, and Sanjeev, you pointed out rural is not doing, there are a lot of issues, there are demand issues, the income generation activity is not happening, and we have certain sort of extended the credit. We also heard in the last conference call that you have taken some pricing action on soaps, particularly on Lux and Lifebuoy. And now what we are seeing is that just 15 days lockdown, and I'm reading from your chart saying that the Janata Curfew which happened from March 22nd onwards, and you have said that the AC Nielsen number is saying that the category and FMCG growth is in negative territory. Would you be able to elaborate that what has happened actually on ground? Is the rural is so bad? Because if I actually see from the data point, the Janata Curfew might have been imposed across, but the rural was still operational. And if I give the benefit that the harvesting and sentiments, they were very strong at that point of time when we went into the lockdown. So what exactly happened on ground?
Srini, let me take this question, then you can add to it. Forget Janata Curfew for the time being. Just look at the February picture. Yeah, the YTD Feb picture for the last 3 months based on Nielsen You were talking about a growth which was just about 2.5% on value on a total India basis and 1.5% on volume. And in this growth, rural was even lower than urban. So against 2.5%, if the shift happens in the month of March to -1, with 15 days of disturbance and 5 days of complete lockout, I don't think it's something which you need to be surprised about. Why should you be surprised about that? These are not big numbers at all.
So what I'm trying to highlight, Sanjeev, is that the rural optimistic picture, what we were thinking of the sentiment change, which has not happened. And come April, when the lockdown is more severe on the rural side, we will see that there is a demand destruction further elaborated or get in Q1 of FY21.
You have to understand rural in totality. Yeah, a lot of people who work in urban, they send their incomes to rural. When people stop getting daily wages in urban, they stop sending wages to rural. So it is not that just because you have not had a hard lockdown in rural, there won't be an impact on rural economy. Most of the construction workers, most of the this entire story of migrant workers, guys, is rural people working in urban. And most of them are on daily basis. When they stop earning, it does have an impact, right? And what we were talking about, that yes, we were expecting that with the infusion of lower interest rates, government's intention to spend more on infrastructure, government's intention to increase the cash transfer to the poor people. And I would believe normally when the government says that in the budget, most of that happens after the start of the new fiscal, right?
Got it. Yeah, thank you. I'll come back again in the queue.
Can we move to the web questions now? Or
sure.
Because I'm also conscious that we have taken a lot of audio and there are a few questions on the web. So Sanjeev, what I will do is I'll call out the question.
Yeah.
And to the extent it's been answered, I will say so.
Yeah.
But if there is something which I want us to answer, then I'll refer it to you. And if there is something else, and then I'll handle it. Right? Yes, I want to just get some of those questions answered.
Yeah.
The first question is from Rishi Maheshwari from AXA Capital. The asking question is, do we foresee media spending being calibrated in the near term? In absolute terms, will we see an impact on media spend? I think I answered this question when I was responding to a question earlier, and I think to Vivek Maheshwari. Given what's happening to the marketplace in the month of April, competitive pressures, non-availability of products, we have seen a bit of calibration to media spends. But we need to be dynamic about this and work it from a month-by-month basis, depending on demand, supply, and how this whole equation will progress. The next question is coming from Nitin Gosar from Invesco Mutual Fund. The question is data shared in slide 4 regarding discretionary and rural. What would be the share of revenues linked to discretionary and rural? I think in the course of the various questions and answers, I think this has been spoken about in detail. I don't think it's just a direct correlation. In fact, the last explanation Sanjeev gave is also a fraction of how urban and rural there is a strong interplay. I think that's the best way to take it. The next question is come from Aditya Malpani from Branston Investments. With income levels coming down for a large part of the population, do you think the demand for personal care segments will take longer to come back? And also it can lead to larger discounts resulting in lower margins. Sanjeev, part of it you've answered. Is there anything that you would like to add to this question?
No, it's, the initial, of course, the feel is that the demand in personal care and all, because right now it's not being produced, the supply lines have been disrupted, and the consumers sitting at home, their increased focus is on the hygiene, health, nutrition kind of portfolio. Yeah. But going forward, I firmly believe that the demand for beauty and personal care products will come back. It will, of course, depend on the supply chain normalization, but it will come back, and there might be some shift in more value packs, value brands that will be there. But certainly, like I said, there's no one in the world who doesn't like to feel good, look good. Even when you sit at home, you would still want to look good, smell good, feel good. Yeah, so those will come back.
Yeah. Thank you, Sanjay. The next question is from Anuj Navare, an independent analyst. How are we supporting distributors and dealers during this time? I think we have spoken about this earlier in terms of liquidity, in terms of facilities, in terms of practices, and even in terms of medical and health insurance. I think there is a comprehensive plan, and we've spoken about it. The next question is from Chanchal Khandelwal. Demand loss in personal care due to working from home is worrisome from a structural perspective, or do you think it will pass and some other categories will do better? I think we have discussed this in detail, and in the last part is what Sanjeev has actually explained also applies to this question. So I believe we have covered this. The next question has come from Nitin Gosar from Invesco Mutual Fund. Which categories does the management believe could take more time to recover post-COVID or lockdown upliftment? Again, I think we've had a full discussion on this topic between the essential categories and some of the discretionaries. What could it mean in the near term? What could mean a slightly medium term? And I think we've answered that in its totality, so I'm not going to repeat it in interest of time. The next question is coming from Kirit Kapadia. When is the final dividend payable? Kirit Kapadia is an investor. Kirit, the board has proposed the dividend. This has to be approved in the AGM. And this will be paid after the AGM is done. And this will be paid on the enhanced equity base, which now includes shareholders of GSK who are shareholders of HUL. We have not yet determined the date of the AGM. We need some more days to see how the situation evolves and whether we're able to come out of the lockdown. That is something that we will keep a close watch, and we will be able to share it with the markets as soon as we can. We will do so. Yeah. The question from Sagarika Mukherjee from Elara is, what is the total price cut at company level that you have taken in Q1 FY21? According to your assessment, what is the total number of retail outlets that are open today and operating? What is the composition of out-of-home consumption in your portfolio and also in Horlicks? I think there are 3 questions to this. From a pricing action point of view, I think we have spoken about a 15% price drop that we have taken in parts of our portfolio, namely hand wash and hand sanitizers, and some parts of our household cleaning, Tomix and others. That's the clear pricing action that we have done. Given the need of the hour, despite significant inflation, we have put on hold many of our price increases. I think that's also an important step that we have taken to support consumers in this hour of need. Second question was really in the number of outlets. At this stage, it's very difficult to get a clear assessment. Yes, sir? Yes, and if you want to add something here?
No, on hand sanitizer, it moved to essential products.
Yeah, so that's 50% price drop. Yeah. Sorry for that. Yeah, thanks, Sanjay. So it's the hand wash and others 15% price drop, and because the sanitizers moved into the restricted essentials list, the price drop there was about 50%, and we have complied with that straight away. Number of outlets, at this stage, it's difficult to get an estimate as to how many are open. I think we just need to monitor this, and we'll take a look. Ice creams and out-of-home consumption, these are meaningful parts of our business, and I think we will share that. I don't think we've put out a public clear number to it, but you get a good sense if you were to look at some of our commentaries in terms of out-of-home from an ice creams perspective. On Horlicks, we will talk about it in due course. At this stage, we're not giving a lot of details in terms of the product composition of Horlicks. The next question has come from Suresh Korada. Will you see sales degrowth like during the Great Recession? I think we've discussed this. I think today we're talking about challenging environment and circumstances. I don't think this is the time to be talking about a recession. I think let's take it step by step. We all hope that India emerges stronger and we are able to come out safer and we'll start to see some growth coming through in due course. We will continue to be prepared for an emerging situation with agility and responsiveness. Yeah. The next question has come from Ankush Agarwal from Stallion Asset. What would be the bottom line of GSK portfolio for the full year FY20? I think Ankush Suman has already spoken about. We just got the merger is effective 1st April. And the books of accounts of GSK for the last quarter getting finalized for inclusion into HUL. And we are hopeful of coming back to you in the month of May to give you a bit of an update on all of this. And I think that will be the right time to deal with some of these questions. The next question has come from Anuj Navare. What kind of product mix changes have we done to deal with the ongoing situations, and how do you see the margin impact of this? I think we've spoken about innovations. We've spoken about prioritized SKUs. And I think we've also addressed the question in terms of how it's an evolving picture. And I think that's the best assessment at this stage. I don't think we should be in a position to really conclude margin impact of all of this, given where we are today. Yeah. The next question has come from Nitin Gosar from Invesco Mutual. Thoughts, consumer spending behavior and premiumization journey India was witnessing. Sanjeev, any comments would you like to talk on this one, more so from a premiumization journey point of view?
Sorry, say that again.
The thoughts on consumer spending behavior and premiumization journey that India is witnessing.
You know, India is not a homogeneous country, yeah? So there are different Indias. And when we talk about our premium portfolio, this is not like buying a BMW or a Merc. We are talking about, instead of buying something at 80 to 100 to a price point, you'd be buying something which would be at 120 to 150 to a price point. So the outlays are small, the premiums are small, and I would believe that many people would still stick to the higher order benefits. But there would be some people who get cash strapped, who lose their jobs, who would be looking at more value, and we then would be having the value brands to